Dude, Stone Temple Pilots, man, that was such a great show. Like, if they were still playing, I would still be there. That was so fun.
I'll be honest, I've never seen them live, and perhaps to give my age away more than I often do, they were definitely one of the better bands that got played on the school bus.
Yeah, I mean, they did, like, in my opinion, they did 3 albums in the 90s. So, like, the first 3 albums that they did were just all 3 of them. Just amazing, front to back. Just all 3 of them, fantastic.
To be fair, there's 2 bands that like right now, like I'm thinking about that. I'm like, man, I'd really actually like to go see them live. Yeah. One of them, it can't be a different band. It has to be the same. It has to be the original band. System of a Down.
Oh,
they are
dude,
System of a Down band.
Yeah, dude, I love System of a Down. Yeah,
and maybe this takes me back 20 years to like the whininess of high school, but I would like to see Green Day live.
Dude, okay, so
I don't know.
Remember I told you, like, I saw Green Day, Weezer, and dude, that was...
I know.
Okay.
First off, and I believe what I said was, first off, fuck you.
Yeah, exactly.
Did you know that over $5 trillion exchanges hands on a daily basis? That's an average of over $220 billion an hour. Now, how does this much money move every single day, and why does it move the way it does? Here on Drunkenomics, 2 bartenders who also happen to be students at the University of Nebraska Graduate School of Business are going to sit down and drink to the global economy and try and translate it into English. So sit back, relax, pour yourself a stiff one, and have a drink with us to the comedy that is the global economy.
Guys, welcome back to Drunkenomics, the drinking podcast with an economics problem, or 3.
Or 500.
Due to travel issues, I've taken a week off, incidentally, and don't worry, I'm glad you guys got the episode. Oh, it hurts. The episode without me, with no gracious host, with too many gracious hosts. I don't know what's happening anymore.
No, it's definitely not enough. But
but by the power of the VIX at just over 25, I am your most gracious host, James Goldwater. Ride or die with me, sometimes even without me, is the less gracious host, Aaron Wong.
Hey, I'm just saying, Tampa Bay has a backup QB in Blaine Gabbert, so in case Tom Brady goes down, not to say that you're Tom Brady, but
I am saying Blaine Gabbert's won a Super Bowl.
Blaine Gabbert does have a Super Bowl ring. And what I'm also saying is when it comes to podcast hosts, like, I just compared you to Tom Brady. So, I mean, you're welcome.
I'll take it. I also feel like I'm held together by the Vicks chewing gum and baling twine, and that and that the woman in my life is better than me in every way. So I'll take it. That's fair enough.
So is Tom Brady. But yeah, dude. So glad you all can join us. Hopefully you have a nice stiff one in front of you. This week for me, it's Irish whiskey. I don't know. I could have done something else, but decided to save some money because I have a freaking flat tire.
And I'll be honest, folks, convenient. I'm just drinking a nice, a good old-fashioned domestic beer because I spent, well, let's be fair, all of my time in Florida drinking just too much of anything else.
Too much rum in Florida?
Someone else paid for it, so it was, don't know.
Yeah, there you go.
But someone else has paid for it, so it was very drunkenomical behavior, let's be fair.
Nice. Yeah, I mean, what are you going to do? Say
the fridge was right there in full. What am I going to do?
Yeah, what are you going to do? Like, it's not going to drink itself. So, with that said, speaking of not going to drink itself, we have social media. It's not going to follow itself. I mean, I guess it could. I guess
it's not going to interact with itself, weirdly enough.
I know, it's because that would be weird if it interacted with itself.
But I will say is this, if you ever do see our social media interacting with itself,
call us out.
That's me.
Yeah.
And
or
I just forget, I'm on my phone and I forget who I am, and I'm like, that's great.
Personal account, Drunkenomics, whatever it is. But feel free to find us there. It's at Drunkenomical, DRUNKOMICAL. That's, I don't know if I said that very well, but that's us on Instagram, Metaverse, Facebook, and Twitter, DRUNKOMICAL.
That's right.
Twice, because I don't know if the first time I said it very well, but
I think you did. Yeah. That's between Metaverse and the Muskverse.
Yeah.
Well,
and then of course you can find us on LinkedIn too. This is Drunkenomics, I think, on LinkedIn. You can just search it and find it. Give us a follow. I don't know if follow ratios on LinkedIn are a big thing that people care about, but yeah, follow us anyways. And feel free to add us if you want, man. I don't care.
Absolutely.
I love hearing from you guys.
We'll try to interact.
I love it when someone messages us and says like, "Hey, huge fan of Drunkenomics. I love that it's so chill and laid back." And I'm like, we are?
All right.
Cool.
I thought we were anxious and neurotic, but fair enough. We'll take relaxed.
Like we try really hard to act like elitists. Just kidding. That's definitely not true. But
I mean,
whatever.
We're the most elite boys in that small town.
Absolutely. And speaking of elite, I mean, I don't know. Do we start talking about the FOMC right away?
I mean, why not?
Yeah, because I mean, it's a bunch of elitists, right?
Some private school boys.
I think so.
And girls.
Yeah.
And girl.
What?
To be fair,
I thought there's two now. Daley from San Francisco, and
yeah,
then
okay, no, you are right.
But what's her name? Bloom Raskin didn't get the gig because every time I think about your explanation as to why she stepped down, and the fact that she was kind of like the sacrificial lamb, that was the word you used, the term you used. So I was like, that makes so much sense, like as to why they would put forth a candidate like this. Yeah, let's be honest, a pretty progressive kind of candidate. Yeah. But regardless, the FOMC, who came out the other day and said that the risk of a recession has gone up.
Welcome to the party.
It was Loretta Mester. Bank of Cleveland. That's what she is. Governor of Cleveland.
No, I was looking her up trying to figure out where she was, and it's like, hang on.
Because I think it was in response to because Jamie Dimon.
Jamie Dimon said there's a hurricane of problems coming our way.
Which hurricane is a very all inclusive. I mean, it's a cocktail of things, man. That's not.
Hurricane's not a hurricane.
It's pretty threatening.
Everyone's like, oh, well, what's the problem with the hurricane? I was like, well, the wind, the rain, the storm surge. The power outages.
And then, there's the eye of the storm that's going to freeze you to death.
Generally speaking, if you ever find yourself in the eye of the storm, you either have just experienced or are about to experience the worst part of the storm, and the damage is always worst around the eye.
Oh, gotcha. So basically, one of those storms is coming towards our economy, according to Jamie Dimon. Based on what he said, I think last Monday?
It was last Monday.
I think because it was right before I recorded with Luke Lloyd, your backup quarterback, your Blaine Gabbert. So because we talked about that for a little bit, and then of course Mester comes out, the governor of the Bank of Cleveland. She comes out and she goes, "Okay, well,
apparently ignoring our very clear memo on shutting their mouths."
I know, seriously. I mean, every time someone comes out and says something, I'm just like, dude, y'all just need to shut up.
Yeah, official communications, and that's all.
Yeah, but I mean, regardless, she did what she did. She went on CNBC of all places. I think she did this on every financial news network because she went on Bloomberg and said the same thing.
There is three. Yeah, let's say, well, there's CNBC and Fox Business, and then you said Bloomberg, and I'm like,
because she went on. She went on Bloomberg, and I think she also went on Yahoo Finance. I forget. I mean, dude, yeah.
Well, yeah.
And the main ones are CNBC and Fox Business.
She talked to anyone with a microphone. Let's be fair.
Yeah, exactly. She went out to everybody. I mean, but the main ones are, you're right. CNBC and Fox Business. But yeah, she went on that.
And she was is a distant third.
Yeah, exactly. But yeah, she went up there, and she was just like, risk of recession has gone up. And I was just like, dude, why? Like, why are you talking?
It's the only thing I can think of at this point is that maybe they're all getting together in the volcano of doom, and they're like, why is no one taking this seriously? Why every time do we mention it, like, hey, bad things are coming? Why is everyone ignoring that? Like, are they? There's a distinct possibility they're sitting there going, and the question becomes: are we irrelevant, or are people that dumb? Like, is it one of those things where they're like, you know what I mean? Like, it's sort of this.
Yeah, but to me, it's just like, I don't know. Like, is everyone just going to believe everything they hear from a Fed president anymore? Because the Fed has lost its credibility. Let's be honest. Janet Yellen came out the other day and said, like, okay, I was wrong for calling inflation transitory. I was so wrong about that. And then, of course, the story after story was...
To be fair, her defense on that, and I really appreciate the fact that she came out and said she was wrong.
Of course, yeah.
But,
I mean,
but that
softens a blow a little bit.
What she has said is, I was wrong, but that's with the ability of hindsight now.
Yeah.
With the data I had at the time, I thought I was right. But looking back, clearly I was wrong.
Yeah, no, but but you also have to ask yourself is, okay, everybody said inflation wasn't transitory except for members of because Janet Yellen said that, but it wasn't just Janet Yellen. Like, it was everybody. Now, so
I will say, like, she is a political appointee.
Yeah.
As the head of the Department of Treasury. She is working a cabinet post. She's part of the administration. She does,
right.
To an extent, she has to toe the party line.
Exactly.
But here's the thing.
But that's the thing with everybody else too. Is but
come on,
dude. Okay, so he knew better. Okay, but he was up for re-election. And guess what happens? He gets renominated.
Yeah,
that wasn't a very popular thing to do
with the Democrats.
It wasn't with anybody. Nobody. Republicans hated him too. I mean, not hated him, but Republicans were like, this guy that has been crying wolf in 2018 when the economy was appearingly strong, right? Which I think, him crying wolf in 2018 was the right thing to do. Hindsight 2020.
Problem is we then get into 2021, 2022, and he's like, Just dogs.
And then
Just dogs.
And then inconsistent again there. So now both parties don't like him. I mean, like Republican pundits don't like him.
Which
liberal
the thing is, like when both parties don't like you,
and you're
actually indemnified from that hatred and that loathing, maybe now's the time to actually do the right thing.
Well, because I think he changed tone as soon as he got renominated, which I felt like, I mean, he should have been renominated, but yeah.
I agree. I do agree. I do think it's one of those things where he was like, okay, I've got to do something to stay here, probably because I don't trust any of the rest of these people to do it right. Part of me wonders if he wants to be, if he looks at himself as maybe like the next Paul Volcker, and that I'm gonna have to do some drastic things, but I'm prepared to do them, and I'm not sure if anyone else here is.
Yeah,
you know what I mean? Like one of those things where it's like, well,
I mean, how drastic can we get right now? Because the main things I want to talk about today are like, okay, so QT1 started last week. I talked a little bit with Luke about it. So QT started June 1st, a week ago from today.
Quantitative tightening, for those of you who aren't in the...
No, I wasn't calling you QT. It's not like
you should have been.
I should have been, because your hair was that, the anime spiked up.
I do. I have the anime swoop.
Yeah, the anime swoop, man. So
for those of you wondering, I am weirdly enough, between Aaron and myself, I'm the one with
hair.
Stupid anime hair.
Yeah, and the person with the last name Wong doesn't. Whatever. I guess worse things can happen.
That's true.
It's like, I mean, it's like our faces are on the album cover of Drunkenomics or anything like that. But and thank God for that.
Thankfully,
yeah. But what is it? What is the schedule? $90 billion.
It's a $90 billion essentially walk back.
Yeah.
So give or take, it's not guaranteed that it's that amount. It's not guaranteed that it won't exceed that. It's not guaranteed that it won't be short of
pending
that.
Economic conditions. Obviously, it's subject to change. But I think they wanted to bring the balance sheet down to $2 trillion after on a schedule of about 3 to 4 years, I think, or maybe less.
Yeah. The issue is, to me, is that they really wound it up very, very quickly, and that they're not willing to unwind it. One, they flat out said they're not going to take it back down to where it was pre-COVID. So they're saying we're going to keep it.
I thought that was what they wanted, was to bring it down to about $2 trillion, which is what it was before COVID.
No, they've said it's going to stay higher than. It may have changed. But everything I've read has kind of said that they're going to keep. They are not going to go. They intend to be above COVID levels.
Yeah. Well, conveniently, the repo markets, have been so active and insanely liquid. The most liquid I think it's ever been ever.
Well, speaking of hurricanes, one of the big things after a hurricane is that when enough rain falls down there, there's just water sloshing everywhere. Streets are flooded, fields are boggy. And it's at times like that liquidity is an issue.
Exactly. So
you want to live on top of the hill.
But I think what's going on with the reverse repos is basically the Fed saying, like, okay, don't do anything with this cash, because we're going to keep doing this reverse repo program, so you can't do anything with the cash. When we unwind our balance sheet, that's what you got to use the cash for. It's so convenient for them.
Yeah, it's very much them giving the heads up to the markets, to the institutions, telling them, yeah, that cash that you've been holding, and that's why it's been hanging out in a lot of money markets, as they've been saying, like, look, it needs to be available in large quantities for us to pull out.
Exactly.
Which in theory should really return money markets to a more reasonable and into a substantially better overnight market.
But you would think, with how active reverse repos, and I guess prior to the active reverse repo was the just regular repo markets were very active. Mm-hmm. Before COVID, repos were, I think, the most active they've ever been. And there was that 1 month where the repo rate just shot up.
Well, yeah, because of the base of tax bills. But it's one of those things where it's a.
But you would think, like, with how active it is, like, you would think that the money markets now are going to generate high interest. But
so the problem with that is
I don't know.
And money markets normally would, but the markets, the economy as a whole, the financial markets as a whole, are just awash with money. There's huge amounts of it. Yeah. And so when you've got a lot of banks and financial institutions that don't have good investment options. And so what do? They just put the money in the out overnight into the money markets. And so that does hurt your standard, like your players who have been there for a long time.
There's too much hurt
because everyone else is now playing, and it's like guys.
Okay, well, so that makes sense.
It's hard to be a loan shark when check cashing stores move into your town. You know what I mean?
Because they have so many options.
A lot of competition.
Yeah, and then on top of that, like, okay, if the repo market, or the reverse repo market, I guess in this case, is $2 trillion, like, do you really think that they're going to want to pay pretty high interest rate on that? Absolutely not.
Absolutely not.
So
no.
I guess what you're saying that makes sense from that angle too. So.
Yeah, when 50 different people are offering you services, you can sit there and pick and choose who you're going to deal with today.
Yeah,
it's
but that also takes me to because if you look at a graph of M2 money supply and the graph of the S&P 500, pretty similar.
Similar movement?
Trajectory, movement, whatever you want to call it. It's pretty similar. Obviously, the S&P moves a little bit ahead of the M1, M2 money supply.
Well,
so
I'll say correlation is not causation.
Well, okay, so if all of a sudden you knew that banks were going to...
there's certainly a relationship. I don't necessarily know what it is.
Okay, all I'm going to say is if you knew Bank of America was going to get a $2 trillion loan from the Federal Reserve at pretty much no interest, would that make you not if you knew about it before they even got the money, if just the announcement of it would shoot the stock up?
Okay,
so that's why.
So in that respect, yes, I know what's causing.
Yeah. So, but that's why I'm saying the S&P is slightly ahead of the M1, M2 money supply. It's the same trajectory, but the S&P is slightly ahead. And it's for that reason. The S&P shoots up before the money supply goes up, and then the money supply goes up, and they follow the similar trajectory for a while. But now the S&P is down, and we all know what's about to happen with M2 money supply.
Yeah.
So
should go down. Needs to go down.
It's going to, but it's on schedule to go down. So I'm worried. Okay.
Let's put it this way. If it doesn't go down, if the money doesn't come out, the inflation's not going anywhere.
No.
That's all I'm saying.
And I totally agree with you because obviously inflation, why does it exist? Supply and demand. Supply and demand of what? Supply and demand of money, right? And if there's M2 money supply...
The more money there is, the less valuable it is.
Yeah, that was my very fast, rational way of tying together why inflation is as high as it is in relation to money supply.
Absolutely. When there's a lot of M2, there's a lot of M1.
But we know they're both going to come down soon. So if it does come down with the fact that the S&P has moved up the way it has because... I'm not saying it's solely because M1 and M2 money supply has gone up, but there's obviously a lot of other factors. But you want to tell me that the influx of money supply didn't affect the way they forecasted earnings? Of course it did.
Yeah, of course
right?
it would.
So
when someone's giving me free money to go play at a casino where I know the pit boss and the dealers,
exactly,
I guarantee you I can make more money. And I'm going to.
The pit bosses are coming up to you saying hey, we need that money back, And what happens now? M2, I think, drove a lot of this price action in the S&P 500. That gets taken away. I don't see any way, and it's going to be taken away. This QT cycle is going to be.
It will be interesting to watch, but it's going to be hard on some people.
It's going to be tough.
That's what I think.
But I think it's also going to a lot of it's going to come out of the markets too. It has to, right? And
it has to. The money has to come from somewhere.
We're seeing that happen in the bond markets right now. The bond markets are getting crushed. Everything's above 3% now. European bonds are all-time high. Bond yields, I should say, are at all-time highs. Not the actual bond. That's the inverse.
To be fair, guys, remember if bond yields are up, that means bond prices are. Let's be fair, down.
That means the value of the bond is down. So bond yields in Europe are, I think, at all-time highs. If not, they're at 20-year highs or something along those lines.
Flirting.
And then Japan, in Asia, it's at 12-year highs or something 8 to 12-year highs, or depending on which country you're looking at.
And the yen, yen took a nosedive.
Yeah, but
decades lows
in relation to the US dollar, which I think, so I don't know what's going on with the euro because I haven't paid attention to the ECB at all and what they're trying to do with the euro.
Well, similar things.
But are they slow?
So they're doing similar things, and then they're also dealing with the fact that there is a war very much happening within their continent.
So they can't necessarily. But that's what I'm saying.
There's some political instability. So they've got.
So I think it would behoove them. Okay, maybe not behoove them, but I think it'd be beneath them if they just decided to do this QT thing right now with the war going on. Because I think that would be inappropriate. Is that fair to say?
That's the thing is, I don't know. They're pumping a lot of equipment into and money into an area, but they're also, remember, at the same time,
they have no energy. They've got
some very serious. They have some energy concerns, and then they also have a refugee crisis now. They've had a refugee crisis for a while because Syrian refugees have been fleeing into Europe and other
to Germany and Italy.
But now they've got, on top of that, they've got 2.5 million displaced, 5 million displaced Ukrainians.
Oh yeah,
heading into Europe, and so it's
That's what I'm saying.
There's a lot of uncertainty,
really
and there's a lot of
and all that is terrible. It's a really it's a travesty. I feel bad, but it's also and Turkey's going through their issues too, which is just
on the plus side, Turkey's to mine, well, let me just make sure I'm going to say this, but I don't think Turkey's part of the EU.
Yeah, they're not.
But they are part of NATO, which is an issue. But Turkey, but I know Turkey's always trying to. There's always that will they, won't they, and it's that Turkey always enjoys being that part of Turkey's in Europe, but most of it's in Asia.
Yeah, exactly. But the thing about Europe is just like, I think they can't necessarily do any QT because they wouldn't help with anything. It's not going to help with the energy crisis there.
Well, they've started to do things. I know maybe if they targeted their QT, they're tightening. So you're seeing, I mean, I forget who it was. One of the nations deployed their oil reserves the other day after some very serious energy incidents. But they need to tighten in some places, but they do need to. I mean, you're seeing a lot of suspensions of petrol taxes and oil taxes to try and keep energy costs low.
Yeah, and I think
natural gas.
And I don't know, like I mean, you know, if you thought that there was a lot of pressure on Jerome Powell 2 years ago, I mean, I can't even imagine what it's like being Christiane Lagarde. Like who's the president? Good. Yeah, I mean, she's under an insane amount of pressure. She's under huge
pressure, and her real problem is that she actually can't control any of it.
Right, exactly.
She has tools to deal with the issues as they come, but she doesn't actually have a solution. She can deal with symptoms, but she can't deal with the actual problem.
Right, exactly. Whereas like I feel like it's a different problem here in the States. All this is to say, like, I feel like, I mean, I wonder how far the S&P is going to scale back with this QT talk. Well, you know what I mean? So
it has to.
Yeah.
I mean, and my same complaint from 2 years ago, I stand by today. You can't have record housing prices during a pandemic.
No, but
you can't have record stock market values when nothing's being produced. It doesn't make sense.
But you can when M2 money supply does this, when the Federal Reserve is purchasing mortgage-backed securities at a pace of 90, or wait, was it? No, wait, what was it? What were they buying? 30 billion or 120 billion in MBSs, or I forget what it was.
It was huge. It was more than the 90 billion they're unwinding.
Yeah, well, because they unwinded it to bring it to zero, and then when they brought it to zero, now they're in this phase where they're just, okay, we bought all these assets, now we're gonna sell them back.
They bought very, very quickly and a lot, and they're selling now back to the market at a slower rate than they purchased.
At a much slower rate, and I think it's fair. Like they don't want to cause panic.
Which makes sense. It does make sense.
But to me, it worries me because I'm just like, okay, first of all, I'm losing that bet with you on that 4,400 benchmark. I'll buy you a bottle of Victor's.
What do we have, 2 weeks?
No, we have about a month. Okay, we have a whole month. So I mean, anything could happen. But I just don't. With QT already starting, it's just not. There's no way. I don't think there's. I'm not going to go out there and start selling 4,400 calls on the SPX. But
it would be a foolish choice, I would say.
I really don't, because it's not financial advice. I'd be hard pressed to believe that the S&P is not going to pull back with this unwinding of M2 money supply. You know,
the money has to come from somewhere. These amazing returns, like these amazing growth in the stock market, came from something. It didn't come from. Here's what I'll tell you. This isn't financial advice. This is just financial fact. The performance of the stock market over the last from March of 2020 through. For 18 months after, until the beginning of this year.
Well, let's say last November, because that's when everything started. That's when
until last November.
Yeah,
that had nothing to do with the actual economic performance, the actual operational performance, the actual business performance of the companies in question. It had nothing to do with them. It had to do with the fact that there was huge amounts of free money.
Yeah.
It needed to go somewhere. And is the stock market a Ponzi scheme? No, it's not.
No.
But
is it rigged?
But if there's more money going in than coming out, it inflates.
Yeah, but that's with anything. That's with any security. That's what happened with GameStop. This is everybody would decide to pile into one stock.
Everyone decided to pile in, and as long as there were more people buying than there were people selling, the price goes up. Yeah. Or rather, not even more people, more shares being purchased than more shares being sold.
Yeah, exactly.
The price goes up.
Or more orders to buy than orders to sell. That's pretty much it. Yeah,
exactly. And so when you see that happening on a market level, because let's be fair, institutions have a fiduciary responsibility to
not
make
hold
money
cash
for their shareholders.
Yeah.
And if they're just sitting on cash, it's not productive. It's
losing,
not productive.
Well, it's losing buying power because of inflation,
especially in a high inflation market,
which really started to creep in over during that time frame you're talking about, that 18-month time frame since March 2020. Inflation started to creep in about 12 months after that, right?
Yeah. So are markets up because there was money and it needed to go somewhere because you can't just sit on it? Absolutely. Is that same supply of money still there? Absolutely not. It is going to start to shrink.
So what do you?
So you're going to see. You have to see institutions start to pull the cash out to repay.
So what do you think, though? Like, I mean, so this pullback that we had was about 20%. Was that just the market discounting QT and the way it's going to get rolled out at the speed in which it's going to get rolled out?
Okay, so the answer to that question, it'll be this. From the smart money's perspective, yes.
Really? Because we've gone sideways the last couple of weeks. So you have a stance.
But here's the thing. A lot of retail investors are dumb.
I don't necessarily think smart money is actually smarter than dumb money.
I don't either. When I say smart money versus dumb money,
yeah, I know they might be charter holders, but I mean,
I don't. Well, when I say smart money versus dumb money, I'm not. I realize it sounds like I'm giving intelligence to one or the other. I don't necessarily know if that's the correct way to put it, but with
that's
what we call smart money or institutional money, that's people that are sitting here saying we've calculated alphas, we've calculated betas, we've looked at all these things. So we think's going to happen. So they're using numbers
DCFs,
to drive their decision making process, right? So they've done a cost benefit analysis. They're numbers driven. And they've done calculations.
Capital,
absolutely, and they've done huge. Weighted average. So they've done WACC. They've
capital
done
asset pricing models.
Absolutely,
stuff like that.
and they're using statistical. They're using statistical significance. They're using historical trends to determine how markets reacted. So they're doing everything they can to take the risk out of investment.
Sounds like a bunch of failed accountants, right?
Absolutely, and I agree with you 100%, and so will my father. But that's who we refer to as smart money. They're willing to sit there and do a lot of math to be wrong or right, but probably wrong.
Usually a combination of both.
If they're not wrong, they're lucky, and if they are wrong, it doesn't always mean they fail. Sometimes they fail up. It happens,
right? But it's also like, the institutional investors know how to hedge, right? So they know how to.
They do,
and they put on these massive positions to help where you can find ways to lower the cost basis.
And they're hedged both on that they have an option for the downside in the event that it starts to swing down, they get out without too much loss. But they've also gone into a complementary good or a supplementary good, so that if A goes down, B shoots up.
Right, exactly.
The increase on B will more than pay for the cost of the option, and the loss on A will still be profitable. Blah, blah. So that's what the smart money's doing.
Yeah,
now the dumb money, the retail investor, is just sitting here going, "I'm buying Google because it goes up. It's going up."
Yeah, no,
that's if the sentiment of the retail investor is to get out of the market, then that's going to overwhelm the institutional.
Because I think it's so tough to price it in. Because one of the things you have to consider is, investor sentiment. What's that going to be 5 years from now? That's not something that can actually, they can't actually factor that into their weighted average cost of capital or their discounted cash flow.
It is nebulous at best.
No idea.
And it is quantified. Right. The most optimistic way I can describe the quantification of sentiment is it is an approximation.
Yeah, and and how do they discount everything, right? They discount everything with the 10-year yield. What's that going to be 10 years from now, 5 years from now?
Yeah.
So
we've got three different things, two of which can actually be calculated and quantified, one of which is at best an idea.
Yeah.
Best. So in accounting, we talk in classes. We talk about there's the three things we talk about. Don't inhale your whiskey, Aaron.
I know
it's good, but don't inhale it.
I couldn't resist. I needed.
But we had three ways of quantifying something coming up, or qualifying something coming up, because we couldn't quantify it. But we'd say, well, something is probable, something is reasonably possible. So we have likelihoods: probable, reasonably possible.
Are you talking
remote?
Are you talking finance or accounting? Because I lost you.
In finance and accounting, we talk about it this way, but it all depends on what we mean, though. So when we say something is probable, probable, it all depends on what you're talking about. Then, because in some classes we would sit there and say, and in some discussions we'd have, it would be probable means that there's a 70% chance of this happening. It's probable.
Yeah, but it also depends on different institutions use different. This 85% probability, right? This determines if it's profitable.
So someone sits here and says we say this. There's a 60% chance of this happening. One institution might sit here and say that's probable.
Yeah.
Another institution might say, well, it's reasonably possible.
Yeah.
So when we look at that as an accountant, someone from the first firm would say, you know what, we're going to go ahead and take the loss now and disclose why. The second firm is going to say, we're not going to book the loss. We're not going to take the loss, but we will disclose in notes that this may occur. And you might have a third company that would say, and this third company would be like Arthur Andersen saying, 65% chance?
Wow.
That's remote. And there's a reason Arthur Andersen doesn't exist anymore.
Well, I mean, Enron.
It's more than one reason, but it's that.
But
basically
I think one of the things,
kind of
so
thing.
like, like the S&P is forward thinking, like we mentioned a million times.
Like all stock markets, hopefully.
Like all equity markets are, hopefully.
If they're not forward looking, I'm more than happy to, within reason to buy into that because
it's cheap. Yeah, exactly. But it's basically like if Twitter,
and that's a
if
big
the market
if. I don't know what you're going to say, but it's a big if.
Exactly. If the market thinks that Twitter is actually going to be bought by Elon Musk, it would be trading above 50 and it wouldn't ever go below 50. Like there's no way.
No.
Because we know at the end of the day, it's going to get bought by 54. It's going to be bought by
54,
some entity for
54.20 or 54.40, whatever
every
you
share, or 54.50 or whatever. I forget what it was, but like if you have a share of Twitter, it's going to disappear out of your account. It's going to be replaced with $54.20 or whatever it is.
And looking back, and I realize my position is evolving on this. And it's not in the interests of Twitter as a company to be privately held by Elon Musk. I still don't believe that it is in the interests of the firm, but in the interests of the shareholders, yeah, it probably is. Like, right? So like,
yeah, I just don't know.
But in that case, the owner's interests versus the business interests are not the same.
Exactly. So if Elon Musk does buy it, his interest
then is the only one that matters.
Exactly. So I don't know. Like it's a lot of things, right? It's one of the, I don't know. Like one of the things I wanted to say too, like to wrap up the previous subject we were talking about, was just like as the 10-year yield changes, the discount rate for everything is going to change, right? And the 10 years above 3% now. I don't know if it's ever going to go down below 3%. I mean,
it's going to be
probably it would hover. It's
going to be hard in the high inflation world we currently live in. It's going to be hard.
Yeah, but the yield is so volatile now, and I think with all this, dude, with QT, there's no way. I don't know. Like I could be an idiot here, but like you want to tell me, like you want to ask me why the dollar index is so strong compared to the rest of the world. You want to know why the USD and Euro is trading at parity. I think it's just because the Fed is acting now. And everybody else is kind of late, right? The reason, or later than us, not necessarily late.
It's not even. I don't even know if it's a timing thing. I think it might actually legitimately just be that the Fed, as misguided, right, wrong as it may or may not be, the Fed has a plan.
Yeah,
no one else seems to.
The ECB has no plan. The ECB is still just debating. They're just which is like
they don't. Yeah, the Fed has said we have a plan. This is what we're doing, right or wrong.
Yeah.
So I have read memoirs, and one of my favorite memoirs to read is Grant's. And at one point, he talks about someone writes about him in a conversation. This wasn't from his memoirs, reading about him, but he made a decision, and it was just he signed off on it. He spent a huge amount of money, of currency, to buy stuff to do, and someone just said, they said, you didn't think about that very long. And he went, you're right, I didn't. And they said, what do you mean? He's like, well, if I'm right, it's fine. If I'm wrong, well, soon enough we'll know, and then we can do something else. Yeah. So the biggest problem is indecision. So you can make the wrong decision, but as long as you realize that it's the wrong decision, you change to a different decision, it'll be fine. It's when you sit here and go,
it's kind of like the NFL. It's kind of like the NFL GMs now. Like draft a rookie, start him. If he's a bust, move on, right? But exactly. I don't know. Like this is the thing is, everyone's saying like the Fed might slow down in September. I don't know. I don't think so.
It might. And if conditions require them to,
but okay, so
they will.
If I had to be honest with you, and I don't know, I don't know what the economy is going to look like in September. I don't know if we'll be in an official recession by then or not. Just based on the jobs report that came out last week, everything seemed okay, right? Like the jobs report was strong, but to me, I do feel like job openings and workers available to fill them, apparently that's going to meet that there's going to be a parity there too.
Well, and that's
at some point
a good thing.
Yeah, and no, that's a great thing. But they're getting closer together, which was like to me, like the jobs report that came out last week was like, if I had to give it on a scale of 1 to 10, it'd be like a 5.001. Like it's just slightly better than most, right?
Yeah.
But like, we're going in the right. I think we're going in the right direction.
Let's just go with our animal spirits, and things are looking up.
Yeah, but to me, it's like things are going in the right direction. I think what the Fed is doing is actually kind of working, which is weird for me to say. But while it's working, just everybody shut up. That's all I'm saying. But
I agree with you. I wish they would only communicate through official channels in minutes, or with the official spokesman after the meeting. I ever so desperately want the maybe it's just looking back at like 2008 when Paulson was like, if the street knows I have if the street knows I have a bazooka, things will calm down. And then they said, well, it turns out a bazooka isn't all that useful if you don't fire it. And then
exactly. We're firing a bunch of bazookas now.
And so, and I do kind of wish that between Yellen and Powell, they'd come out and say like something to the effect of, if we have to take a drastic action, we will. So you need to calm down about nickel and diming us for every little bit. We are capable of extreme action, and if necessary, we'll do it.
But I don't. I think literally how the Federal Reserve is keeping the banks in place is by doing this reverse repo. That's how they're keeping them in place. I guess what's happening
is they're couching a lot of things in very dovish language. But I wish that like the facade would slip for just a second, so that like Powell could be like, you know what I mean? Just like it's like that angry look of like I will turn this car around. That kind of thing.
We're gonna go back home.
I will turn this car around.
You want your ice cream or no? Come on, let's go.
Exactly. Now, to be fair, that wouldn't be good for anything other than like my personal spiritual well-being.
I understand that, but like it's kind of like, like when your parents take you to go out, get ice cream, right? And you're being a little rat with your siblings, as you do when you're 4 years old, right? Like, it takes one to know one. I wouldn't know either, man.
I'm an only child. You're the one with
the siblings. Okay, that part. Yeah. But we're being little brats. We're fighting with each other, calling each other fat or whatever. It's what siblings do. You know. And then on the way there, it's like, okay, you guys aren't going to shut up. I'm just going to turn the music really loud. And at the time, if it's like a nice little All American Rejects song, because that's what I listened to in elementary school. I mean, come on. Who doesn't love
this
pop
guy played
punk?
on a golf course, folks.
Yeah.
They let him onto a golf course.
They let me onto a golf course. But to me, like that All American Rejects song, that's kind of like the
That's kind of
like the reverse repo markets. It's kind of like the reverse repo markets.
Yeah.
So it's just it's keeping them silent, right, until they get there. But doesn't mean they can outfuss and outbrat the song, because that happened before. We did stuff where we drove our parents crazy enough where they'd turn the car back around, even though they played our music, the Switchfoot song or whatever it was. But
so you're saying that the feds just turn the music up and they're going, I swear to God, I'll turn this car around. Yeah, but I'm not there yet. I'm not gonna. I don't have to say it, and I don't just have to turn around.
But that's reverse repo markets, right? Because I feel like if they really wanted to, they could just be like, all right, boom, everything out of the economy now. Let's reduce N2 money supply, because that's kind of what Russia did, and it worked for Russia, right? With the ruble, that's why the ruble is stronger than the dollar now, or not stronger, but that's why it was originally.
It is the best performing currency of the year so far,
which
in
is
terms
absurd,
of growth.
Which doesn't make any sense. But
it had a devastating drop, so it of course it had an amazing increase. It's kind of like when everyone's like, look at U.S. markets are up 70%.
Yeah, but do you remember when the Russian central bank raised interest rates to like
20%,
like 30%,
20%, whatever, more than doubled to 20%,
and then they've since brought it down to like 13%, which is still absurd.
Yeah.
So I think those extraordinary measures, that's them just turning the car around and go back home. Right? That's what that is. So like if all of a sudden,
Russia's got some.
Yeah, I'm just saying.
Other
if all of a
problems,
sudden I understand that, but let's just look at their currency, right? Let's look at their inflation.
They've staunched the bleeding on their currency.
Yeah. So
that's
what I'm saying. Is like if you think the central bank here turns the car around and then just go, hey, by the way, interest rates are now 4%. Live with it. What do you think is going to happen to the U.S. dollar?
I mean, it would go haywire. And of course, that would crash everything else.
Of course it would.
And of course, that would then crash the US dollar. And of course, then that would crash just everything else. Sorry, yeah. Exactly. So there's obviously you need a stabilizing adult influence in the room, and I don't deny that.
Yeah, exactly. But I'm just saying, like, if they raise interest rates to 4%, like, obviously.
Well, if they do it overnight, I think we're probably going to end up there.
Yeah, I think we will too. Yeah, I mean, but I'm saying like
as maybe a halfway mark on our road to 8. But
I know. All I'm saying is like at the next meeting, if they went 4%, okay, so we're gonna lift up 300 basis points. Good luck, everybody. It's like, okay, bond market crush, stock market crush.
On the plus side, we have circuit breakers.
Yeah, exactly. Do we have circuit breakers in the bond markets though? I have no idea. But
you'd see yields in the bond markets plummet because people be buying into bonds hard.
With interest rates going up to 4%, no way.
And you'd see people piling into long-term bonds and trying to get new bonds.
No. If they'd be getting into new bonds, that would lift yields now up.
Okay, I'm sorry. Yes. No, you are right. I am
yields.
Okay, sorry. You're right. Yeah. Yes.
What you were saying was agreeing with me, but you were disagreeing with me and agreeing with me with your reasoning. So I was like,
they're
piling the bonds now, and I'm like, okay, well that would crush yields. I mean, that would make yields shoot up. So I was like, you're agreeing with me.
Yes. No, I misspoke. I'm sorry. No, you're right. Yields would be. Yields would be through the roof.
You'd shoot up. So
as people pile out waiting for new bonds to come out and then dive into the new better coupon bonds, giving them garbage yields because they have great returns.
Yeah, so that would make yields shoot up, thus crushing the bond market.
Of course, on the other hand, you might see, and this is my attempt to defend myself, is that you might see people as they bail out of the stock market just diving into whatever bond they can get into because at least it will hold some value. Whereas the stock market they're leaving is about to collapse.
If you hold it to maturity, I guess it'll.
But you're looking for people
if they have a good credit score or whatever you want to call it.
But you're looking for people trying to go somewhere that isn't cash.
Of course,
then people might just be going to cash. Who knows?
Yeah. Well, with interest rates going to 4%, like I mean, at that point, it's like okay, the dollar index is going to be strong enough. I mean, like say what you will, like the dollar index will improve. I mean, it's gonna shoot up to like 108 or whatever.
Well,
but yeah, I mean, like why? Like at that point, like the dollar index, I think, would be so strong. Like it could buy you so many Drunkenomics hoodies.
Yeah.
What?
Drunkenomics hoodies, Drunkenomics bandanas, Drunkenomics coffee mugs, Drunkenomics golf shirts for the summer.
Hoodie?
It's June. It's July. You can get a golf shirt
for
the links. You can get a hoodie for the winter.
I
don't know what natural gas is going to do, but I have a feeling it's going to be more expensive this winter than it was last winter. That's mainly because Russia is doing its thing, and Europe is still going to need gas.
I will say this, and this is not financial advice, because I'm telling you this so you can possibly go on the other side of my trade. But I did buy some energy transfer call options, and tomorrow I'm probably going to buy.
You're finally playing on that?
Yeah, I finally jumped in because I talked about it for a long time. I finally jumped in.
Okay.
Yeah, I bought some options that expire way out in time, so it's not like it's expiring anytime soon. I have a lot of time to manage this trade, so I'll be fine. But yeah, I probably should have just spent that money on a Drunkenomics hoodie, one of those dark black hoodies. Probably would have been much more bang for my buck. That can be found at drunkenomics.myspreadshop.com. That's drunkenomics.myspreadshop.com.
Excellent. I couldn't have done that.
I don't know how I did that.
You can get some.
We also have our.
You can find us also at patreon.com/drunkenomics, DRUNKENOMICS.
Nice. I mean, that was.
Did I spell that?
It was good compared to the first time you did it. So I mean, that was great.
That's true. The first time I did it, I think I spelled drunk.
I think you did too. But you know what? I can't really be mad at you for that. I really can't.
At least I got that
because
right.
At this point, I mean, this many drams in, I'm playing with my fruit peeler now. That's how drunk I am. I'm twirling like a little pen.
But yeah, if you want to help me, the worst thing in the world you can see with Aaron is that he's got a fruit peeler but no fruit to peel, and that's just unacceptable. He doesn't have lemons.
I truly don't have lemons. I'm not even
He doesn't have oranges for his old fashions. He doesn't have
rye.
limes.
I don't have a lemon though, or an orange for my rye.
Folks, it's getting bad out there.
I need one of those for my rye.
But having said that, yeah, if you want to help us keep the liquor cabinet stocked, the lights on, the mic's hot, the ice cold.
Yeah, but I mean, you said the link, patreon.com/drunkenomics, and last but not least, from there, please check out our social media, LinkedIn, Facebook,
write a review
Twitter,
of us
Instagram,
somewhere. That's always cool. It does help us. It does help us get out there. It also helps us know what we're doing.
But in the meantime, I just want you to know, does it get worse? Does it only get worse?
No, it only gets better, except when it gets worse. But that comes from that comes from playing chess, not checkers.
This is the same
sometimes
map
you lose.
over
Sometimes
and
you
over
forget
again.
that. Sometimes you forget that that's a bishop on black, and you shouldn't have put your queen there.
It's why did you do? And then you put your knight there, and then
flanking attack, and you're
I
like,
don't know.
come on.
But you can make up for all that by doing what's that one thing?
You just gotta stay drunkenomical.
Stay drunkenomical, man. Cheers, my friend.